Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, January 27, 2022. Now that we have the Fed out of the way, we have one last potential market moving event on deck, and that would be Apple. Apple reports after the bell tonight. Make no mistake about it, they are the 800-pound gorilla in the room, biggest component of the S&P 500 and NASDAQ 100. First to become a $3 trillion market cap company recently. That's come back down to 2.6 trillion now, but it is still by far the largest component there in the Nasdaq 100. Microsoft's behind it at 2.2 trillion. So point being, it's going to move the market. It is the market, and so how they do after earnings. So we're going to take a look, just dig into the charts on that stock. Before we do that, before I get away from the well, let me start out here, I should say, with the markets. And so that potential bear flag is still very much in play. Bearish pennant really on QQQ. You have that impulsive move down. You have this pennant type action right there. And so look for a breakdown. Now, the market, just like it goes kind of in a holding pattern before the Fed meeting on that day, same thing usually happens with Apple. Sometimes you'll get some late day buying or selling. More people think it's going to go up after earnings, they're going to buy it. If more people are worried about a drop, they're going to sell. But for the most part, I don't expect any big fireworks today. Probably consolidation day, so another day probably to take off. I'm going to go over some short-term technicals as well for those of you that want to actively trade. This market's been printing money lately, as for active traders. Anywho, that's it. So there's that potential flag, and QQQ is still well south of the 200-day moving averages, and the big levels remain at top of that trading range back there. If we really get some traction going on a bounce, let's look at SPY before we get onto the individual components. So SPY still very much taking the form of a potential bear flag right there, impulsive leg down, flagging type action. So that would be quite bearish. So what you'd want to see is an impulsive move down through there, break, an impulsive run, and then that's going to take you down to those measured targets I gave you yesterday on again, you can just replicate anytime you see a bear flag bull or bear flag or pennant continuation pattern. Just take the flagpole, add it to the highest part of the flag before it breaks down, and again, that's going to put you right around my 397 target there on SPY if that is to play out. Starting to see the PPO cross down below, and again, here's another opportunity. We're back to those 200-day moving averages where we were yesterday. That was a shorting up then, still is, and my range remains. Nothing's changed. Any short entry, objective short entry, goes anywhere from here where we're at now to the 200-day moving average. I think you can see it here in blue. If not, that's where the 200-day comes in, right where we are, up to about that 450 level, and then after that you could give it a little room on the stops, and then you'd want to start scaling out again depending on your target. So your stop may not be the same as the guy or gal standing next to you, metaphorically speaking. They have different entry points, different targets, and so your stops should be commensurate with your price target or targets, plural, whether you're going to scale out or actively trade, zigzag the way down, counter trend, play the counter trend bounces, or just hold tight, and use an attractive risk reward ratio. So that's where we're at. Flags persist for now. Doesn't guarantee that's what they're going to be. Again, it's like any chart pattern, any technical pattern, bullish or bearish, is a potential. It's a potential pattern, and then it needs to trigger an objective entry. So this one needs to break down, and that's that. All right, let's talk on, let's go to the daily chart. We already did the daily, I'm sorry, let's go to the weekly. Remember, we are still, this is the initial tag. This is the first week. We just hit T1 this week, and we're still having that typical reaction on it. That's reaction I define as a consolidation, which, in the bigger picture of things, so far that's all it is, and or a bounce. We bounce somewhat off it, but again, we're roughly right on it right now, and I still favor a breakdown, whether we bounce a little higher or not. So up to you whether if you share that view. I've given you objective levels to go long, to re-short or add to shorts. And if you are a bull, well, we hit my first target, and sometimes that's all we get out of these trades. And so you can buy here yet. You're still relatively close to support. With a stop, I'd have it just somewhat below the recent lows. Makes sense, and then let it run. I've given you other trade ideas. One of those recently for longs was Netflix. That was a beautiful support. If I was more optimistic on the intermediate to longer term outlook of the market right now, this would be a top holding in my portfolio. I actually told you I bought it the other day, but then I also sold it yesterday. It's up a little. It's up nice today. Oh, that's not a good number, 6.66%. But either way, and again, one of the better looking, if I had to have just one stock in the NASDAQ 100, that would be it right now. At least I haven't gone through all 100, but that's one I would certainly rather be long than short right now. But again, I think we're going to break that support, and the baby gets thrown out with the bathwater when that happens. Netflix is a component of the NASDAQ 100, so if we do break my support level, on the indexes and have another major leg down, it's going to put pressure on Netflix, most likely. But again, if you want to trade it up, there's a bounce target back to 475, and just take it with a stop somewhat below. And even then, that's being reversed today as we speak. So, like I said, that's the nature of the beast. And the takeaway is same thing with Apple. It's going to trade after hours. Don't try to read too much into it. The market will have most likely digested what they need to by tomorrow. So we'll know which way Apple's going and most likely which way the market's going. I think we're still at a critical juncture. So I would take again that trend line break with a grain of salt. This bounce right here is to be expected. Again, QQQ hit my first target and bounce, and because Apple's a top component, it's going to bounce with it. So this is just nothing more than the expected reaction off the tag of T1, which coincided almost perfectly with that 157.31 target. Now, take away all the lines. What do you see? I see also another textbook looking bear flag. So there it is, guys. If the street doesn't like what Apple is selling tomorrow or tonight, and into the rest of the week and next week, you're going to see this. And I have to say, I'm leaning that way, and I'll tell you why. Not just because I want to see the stock market fall. No, it's all the technicals I've talked about. This is a daily chart. This was a divergent high. This was one of many reasons, for shorting recently. It was imminent that appeared imminent that we're going to get a breakdown, and we did. And we got sell signals. We broke down the bearish rising wedge, a little kickback rally, and we've been moving lower. So, and for those of you Elliott waivers, if that's what you are, then you can say this was a wave ABC. I'm sorry, 5-wave correction. First wave down, counter trend rally. A, B, C, which is always the most powerful, or wave 3 of a 5-wave 4, and then you get one more leg down, and that would take Apple down. So that is a likely snare for Apple. I gave you upside targets. You can buy it here if you want to gamble into earnings, or you can sit back and watch and see what happens and then short it on an impulsive break, which would probably, since their earnings are coming out tonight, it's probably going to be in the form, if we get that bear flag breaking down, probably be in the form of a gap down. And remember, nothing's more impulsive than a gap down. You want to see an impulsive breakdown. I always say the redder the better. But if we gap down, then even though there's no red candles there, that's even worse. A gap just it does bad things to the longs. It just leaves them, standing there, and it bypasses their stops, and they're waiting for a bounce that usually never comes. That's the nature. Again, if this bear flag is going to play out, it's going to most likely look like this on the way down. And if it doesn't, you buy Apple here. Hold your nose, sit tight, or keep your stops in place and let it run if that's what you think things are doing. Like I said, it hit support. I still think it's coming down. We got a trend line here. And now let's look at the weekly chart. This is Apple on the weekly time frame, and we're coming off a divergent high right here. In fact, pretty big divergent high. We had divergence starting at this point. We had a first DH1, I call it, divergent high 1. We had a 21% correction, right? And that was off a relatively small divergent high. This is the same divergence. That divergence line has extended, so it's just simply an extension of the previous divergence. And logic would dictate, because usually the case, the bigger the divergence, typically, not always, but typically the bigger the drop. So therefore, I'm looking for more than a 21% 45% drop after this. In fact, what am I looking for? Well, let's just look. And keep in mind, I'm going to go over this. I've done this many times in the past, covered this chart. Each of these, again, on the weekly time frame, these are divergent highs. This was a little tiny divergent high, but it was still good for a 35% drop. See, so it's not always, the scope of the divergence is not always commensurate with the move. But what you look for, not just divergence, you look for sell signals. Clean breaks of support, like well-defined uptrend lines like we had right there when COVID hit. Again, I've talked about that many times. COVID wasn't random. COVID in itself was a black swan event, but again, the technicals were pricing in. We're going to get a correction one way or another. We just needed a catalyst. In that case, it was a fundamental catalyst. Sometimes it's just a technical catalyst. You break down, and we probably wouldn't have dropped 35% so fast. Almost certainly not if COVID hadn't hit. But again, COVID just took the markets and a lot of stocks where they needed to go. In fact, they were pricing in even more downside, but the Fed came in and saved the day and did this. So therefore, now the Fed's starting to undo all the easy money, and that's why we could have a much bigger drop. And there's a long-term target for Apple. There's this trend line down here. All right, just to carry on. Okay, previous divergent high before that was in the fourth quarter of 2018. There was another top that was well forecasted in the market, and we caught that short, gained the counter trend bounce in the middle long, got out, got back in. That was good for a 39% drop. So again, this is Apple, the market's beloved Apple, world's largest publicly traded company. 34% drop, divergent high, 45% drop after the divergent high. Series of 3 consecutive divergent highs with a 26, 15, and 16% drop. Go back all the way here, and again, there's not many. I believe I've gotten them all. Didn't miss any here. This is a weekly chart. That was one back that Virgin High was put in October of 07 when the market peaked. That was the last bear market, and Apple dropped 62%. Doesn't look like a lot there, but a 62% drop would have wiped you out if you were long, because I use log scaling, so it puts everything in equal percentage terms, and there's a 42% drop. So you get the picture. This is based on my analysis, I could see Apple coming back down to this trend line, and as much as it's already dropped from the highs recently, I'm just trying to measure out, and depending on when we get there, and the when is usually pretty fast because stocks tend to fall a lot faster than they rise, so that'd be about a 60% drop if we hit that trend line in Apple. So just kind of something to keep in mind. And again, if you say, oh, Randy, you're crazy, Apple's not going to drop 60%, again, that's what it does. That's what it did in the last bear market back in 2007 to 2009. And even in the bull market, the biggest correction we had was 45%, and you had several others that were about 40 right there, 34, 39, 35. So just something to keep in mind. This one has just started to crack, and there's the uptrend line too. There's their primary uptrend line, secondary uptrend line, and the divergence. So this is, if that flag on the daily breaks down, it's going to trigger additional sell signals that you don't see on the daily, you're going to see here on the weekly chart. So there's my analysis for Apple. Here's another chart, just again pick on the market leader. This is a monthly chart I just rolled back to. So we're going back as long as you want to go back. And what you see here, again, you have divergences right there, negative divergence followed by a 42% bear market in Apple. Negative divergent high, 62% drop. Divergent high on the monthly, 45, 32, and I thought there'd be more of that when we hit that, so that's why I said that. Only a 32% drop, question mark. Yep, right, there's the rest. We kept falling. That was over a year of correcting in Apple before all said and done. It wasn't the most vicious correction, but it was a long time. You were losing money steadily for over a year if you stayed long the stock. And there's 39%. And again, what we have now on this monthly time frame is the biggest divergence that we've had. The only thing even close comes back all the way back in 2004 and 5 right here when we had that 42% drop. The other things to note, I like to look at the PPO histogram. That's these green and red bars down here, and it defines trends. So up to this point, the trend was bullish. From there to here, we had that flip over, and that coincided. It caught. It got you out, or at least predicted that 42% drop, or didn't predict it, correlated with it. And then we picked up. So they're not exact timing indicators, but the point is, every time that PPO flips, it's been associated with those big drops, bear markets, corrections, or if you want to call them corrections of 20% or more. There was one there. That one didn't do much, so that one we'll call that a whipsaw. But here's one there, 45% drop followed. There's one there, one over a year and 34% of downside. There's the last one there, 39%, and here it is here, but yet nothing. So will this go down in history as a whipsaw similar to this one here? And even if you looked at that one, you probably were pretty much flat for about 6-8 months right there. So that is Apple. And that's what we'll watch for to see how this stock trades after today, going into tomorrow and next. And although Apple is the big dog, it's not the entire market. So just to look at some others, here's Microsoft. I had a couple levels here in yellow, important levels, all which gave us sell signals when they were taken out. We're back testing that 30. That's I know it's hard to see in the video. 305.90. We'll call that 306. Back testing now, but we're also popping the trend line. We had a breakout there, impulsive. So you can say that's bullish. The impulsive break above the downtrend line, and we're still above it right now, but you also have a mountain of resistance overhead, so just keep that in mind. PPO starting to turn up on the daily, and that's also bullish to see a bullish PPO crossover on the daily chart. You can evidence that by looking at the histogram. So if you get it, well, we had one right there. Oops, I didn't get that exactly. It was right here. It's the first one. There was one right there. That caught a bottom. There was one there. Caught a little rally there. And we had a bullish PPO crossover there. So that's, glass half full stuff. You guys know where I think we're going. I think it'll prove to be, sometimes this PPO, like right here, it looks like it wants to cross, and then it gets rejected at the zero line. And that's fairly common. So those are things to watch going forward. And those are things that will more check marks we get for the bullish side, and checks against the bearish case, which means taking out resistance levels that quote unquote should contain any pullbacks. Then my longer term outlook may gradually shift, at least my intermediate term. Let's just say it's going to take quite a bit more. You're going to have to really do more than just run at the old highs to change the technicals on the long-term charts. But we'll see. We'll watch those monthly and weekly indicators and things like that. Here's Amazon. Amazon took out that key level there to 29.4350, and we're still below it. And here's another stock, another one of the big fangs that looks to be flagging. So I guess the takeaway from this, guys, look, if the market's headed where I think it's going to head, it could happen very quickly. You're going to get these one-day rallies. Everything's giddy. Oh, the worst is over. Bargain hunters step in, and then boom, all of a sudden it takes just one day, one big pulsive break out of these flags, and if the dam breaks, you can see that waterfall selling. And again, they're pretty clean looking flags. Doesn't guarantee they're going to play out, but this is a lot of flagging action on these market leading stocks. And again, and the thing is, they're in technical or precarious technical postures. Amazon's well below the 200-day moving averages. I don't know if you can see them here, and the 50. You get all, I have the 200s and the 50 all there, all crossing down, and that stock is below all those moving averages. The last time it was below them was during when COVID hit right there. And again, log scaling, it doesn't look like much, but that's it. Took them out. Otherwise, they act as support. Here, I'll turn them up. You probably can't see them. There's 200 simple, 200 exponential, and when stocks are below their 200s, you're usually in a bear trend. Sometimes that trend can be very quick. Again, this was an artificial stop to a bear market that should have had more downside with the extreme measures the Fed took, but it is what it is. It was a big drop. You can say what you want. It was a 22% drop plus in Amazon. But again, here it is. We broke it here, broke the 200s, tried to backtest them and failed. And so you can go back in time and see how the stock is traded there. So that is why you have to right now take these counter trend rallies with a little bit of skepticism if you are bullish and you're drinking the Kool-Aid that they're dishing out on TV, most likely the majority of market pundits, because we have quite a few sell signals and we're rolling over. Quite a few have started to roll over on the longer term time frames and key stocks below their key moving averages and things like that. So Yeah, until we get more bullish evidence, I think I'll remain in short the rips, cover the dips kind of mode. And I just rifle through these fangs. Even Tesla, Tesla reported, of course, blowout quarter. They make tons of money, making money and profitable now. But look at this. That was the yellow line I had on Tesla. See that yellow line right there? And we broke down. There was our sell signal the other day. We back tested it right here yesterday, and boom, post earnings down 5%. That is a breakdown. And if you missed the breakdown, you didn't short it, it's a back test. You had another op. And now the earnings are out of the way. It's been rejected off the back test. And so, really, what I want to see is this should have been yellow as well. We'll call that 905 level. But like everything, just the recent lows. Take out the recent lows, it's going to put all those support levels in the rearview mirror, and that's what can happen to Tesla. Otherwise, Tesla bulls need to see this trend line recovered, and if they recover it, then guess what? All this was a whipsaw, false breakdown, and the stock may run at the previous highs. But unless that happens, it's on a sell signal. Okay, and just a quick look at the shorter term charts. This is at T5 level on QQQ that was here. Remember, we ran up, back tested it several times, and we're back testing it again. PPO is also back testing these key levels right here. These lines, that purple and white line down there just below the zero line, really do a good job at defining bull and bear trends. When the PPO is above it, you're in a bullish trend and it acts as support, but once you break it, the trend's bearish. And so we're back testing that from below. So here's the thing, if we can power on up here, it flips that trend indicator, you take out resistance, and then maybe you run up and back test that former T4. That's your next target. But until then, we're still in a precarious position in the markets. We even broke that trend line. There was that little flag, when you look at it on the 60-minute chart, broke down. It's a little back test. And so if they dump this today, you still have the potential for these flags to break down today, and then Apple could just be the 1-2 punch that takes out, the market again, depending on how earnings go. They're going to go either way. Okay, and let's look at the futures here. Let me turn off volume. I had that on. I was doing some things, been actively trading the last couple days. Alrighty, so way back when I laid out just as things we were still near the top, but we had some sell signals. Remember 1, 2, and then every time we back tested that 1640, 444-ish level. And then I laid out this if the dam breaks and things get ugly target, which came in with that major reaction low right there. And so far, that's been capping everything. We tried to pop it yesterday. Remember, there was a lot of noise, post FOMC noise, so we got checked there. And it's just been numerous reactions on there, failures, so to speak, more accurately, on that level. Again, we can power through there, then near-term bullish, but there's still, you've got that previous reaction high to contend with, 14,790, and then even some levels up there, resistance levels. Let me walk it down to that's a 120-minute chart, by the way, guys. This is it on the same thing, NQ on the 60-minute chart. So again, we're at resistance. There's a downtrend line. Rough downtrend line, little whip there, but that's it. That's enough reactions. 1, 2, 3, 4, 5, and so there's if you're looking for areas to short, we're right there. I showed you earlier. The S&P is at resistance. We're at where my scale in zone, and you can short all the way up to, remember, the bottom of the recent range up there. But at that point, I wouldn't add to shorts. I'd be more concerned about scaling out, stopping out if we got that far. As of now, this is my preferred scenario. So that's it, short here or near that trend line. Now we're going to walk it down to the 5-minute chart. I've been having a field day with this one. Just looking for, of course, yesterday was a Fed, but you get all these little chart patterns here, and you look, you get divergences. There was I'm not showing there. There it is. Divergent high, and then you strong reversal, and you took out the trend line, moved down, a little pennant action there, moved down. Then we had this trend line here that was taken out. That formed a bullish falling wedge with positive divergence right there. at support as well. We had 13,882 support, broke out of the bullish falling wedge, and then last night I noticed boom popped here. That was the next buy signal, and that set up this rally here. Now what we have at this point in time, I'm going to move this divergence line just a hair. So we do have negative divergence here on this little, this is just a micro chart for active traders, short-term traders. We have negative divergence now, right there. There's your divergence line. Here's your uptrend line. So if you're looking for, let's say you want to ride up a long that you're in right now, or you want to short, a break of that trend line should do the trick. I've got some Fibonacci levels up here as well, and resistance levels. And it's a busy chart, a lot of lines. The color-coded lines are fibs, and the white lines are price resistance. I have price resistance right here at 413.50, which we just hit. That goes back. I'll show you why that line's there. It's been there a while. Reaction there, reaction from below, almost a reaction from above, perfect reaction from above. Traded through it there a few times. And so that's it. So same story. We're at resistance. You can short here and or on a break of that line right there. Minimum pullback target right here, 14,249. And again, this site's not all about day trading. I rarely show you these very short-term setups, but I'm just telling you what I'm doing lately. Alrighty, ES, same thing. You've got the ES right here, similar uptrend line. There's a divergence line right there. We're just holding on to that divergence right now, and you're at price resistance plus a 76.4% fib right there. That's price resistance as measured by all these reactions, or defined by those reactions. And then the trend line, and then if you want to just a quick minimum target, I'd say right here, that's about 43.55 right there. You can see level right about there. And again, minimum target. You're swinging. This is a 5-minute chart. If those flags break down and we keep moving down here, and of course look for a break of these recent lows. Probably more so this yesterday's low than the one back here. All right, let's wrap it up here. Keep this one relatively short. That's what to look for. Those are the levels to watch, and trade off them if you want. And again, might be a little back and forth grind. Might not even be a bad day to take some time off and then pick it up, see what Apple does tonight after the bell. And I will most certainly follow up with an update. If not after the close, once you see what Apple's doing, I'll get it out tomorrow. Again, I won't read too much into the initial reaction unless there's some really big movement after hours, and if so, I'll give you an update. If not, we'll just pick it up tomorrow. Not that I'm done for the day, but I don't see a lot right now worth updating. But again, I'll dig through the charts over the next hour or so and probably get something else out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.